Hello, my name is Blaine Anderson. I'd like to take a moment and share with clients here at Bander Wealth Management a few details as you review an account statement, and in particular, a couple of investments that we customize here as part of our portfolios and on behalf of clients. This is in reference to our income notes as well as our principal protected market linked notes. As many of you know, we insert these types of investments to help manage volatility and to also improve the risk reward ratio within our actively managed accounts at Bander. And so oftentimes when you receive a statement each month, some of it might be a little bit confusing. I'd like to take a moment and share with you in particular how to read the statement and the account values for our income notes as well as our principal protected notes. On the screen is an example. And as you can see, we have a number of the CUSIPs listed to the far left. And in the middle, you'll see the institutions that have issued those notes that we've worked with directly to customize a note and to issue it on behalf of investors. So it could include Barclays, Bank of Montreal, Morgan Stanley, and these are considered to be fixed income. So we use these a lot of times in place of bonds or traditional bonds because they are debt instruments. And in my example here, you can see these are done in $50,000 allocations. Now, to the far right under the description, you can see the maturity dates, and you'll notice even the coupon or the opportunity for return. And that's all part of the description. However, over the course of these terms, we usually issue them in 12 to 15 month time frames. You'll notice that the price does fluctuate. And that's because although they have buffers or barriers, if we were to sell these particular investments prior to their maturity date, especially when the market's down or when the underlying securities are down, it's likely done at a discount, or as we like to say, with a haircut. Although we can go and price them in the secondary market, that new buyer or purchaser wouldn't have as deep a buffer as we have at the start. So for example, if we have a 50% principal protection, and the underlying securities are down 20%, well, that new buyer only has a 30% buffer remaining. I hope that makes sense. And for that reason, they would pay less if those underlying securities are down. And so on your statement for the month, you're going to see what that discounted value would be approximately. It gives you an idea that if we were to go and sell one of these individual investments prior to maturity, especially when the underlying securities are down, then it is likely at a discount or less than what you put into it. However, our objective with these investments are to hold them to maturity. And as long as the underlying securities are within their buffer, and in particular their principal protection, then we expect a full repayment of principal. So I want you to be aware of that as you look at your statements, especially when the market or the underlying securities are down. If you have any questions on this, please feel free to reach out to our office. Now, we've also been sharing more about our principal protection market linked notes. And you'll notice, similar to the income notes, you have a CUSIP number, you have the issuing institution, but you don't see a coupon because these are credited at the end of the term. However, you will see the end of the term, the maturity date. Now, similarly, these, if sold prematurely, would be sold at a discount. So we paid $100. That was our par value at issuance. But even with the market being down, these are priced below the par value. And if sold prematurely, would likely be sold at a discount. And the market value that you see on your statement likely references or refers to that discounted value if sold prematurely. So please take that into consideration. And then as we provide performance numbers to you, we will show that discounted value because that's more in line if you sold now. However, our intent with these investments is to hold them to maturity. Now, another thing I'd like to point out, when it comes to our income notes, this is a tracker that we use for individual notes. And upon your request, we're happy to share this with you. What it shows is the issuer, the initial valuation date. We show our underlying securities, and you can see how deep you are into each of those buffers by just simply entering the market value or the share price for any given day moving forward. And then the idea here is that it will show you the value today and then what those values can drop to in order to still receive our monthly interest payment, or in other words, our coupon, and then what it could drop to and still have our principal protected. So this is meant to be a way to track an individual note. We give the date and then our annualized coupon or interest rate so that you can track and you can look up each day in the month. You can look up your monthly date and see if you will receive an interest payment for that month. And you can also track how you're doing on your buffer with those underlying securities. Now, our risk, we know that if the underlying security, if one of them is outside of its coupon protection for the month, then it will skip that monthly interest payment. And then the thing that we're tracking closely is on the maturity date being within our principal protection. And so this particular one that I have illustrated on the screen has a 50% principal protection and is tracking NVIDIA, Salesforce, and Oracle. And if for some reason one of those underlying securities were to fall outside of its principal protection, then we have underwritten these notes with the idea that the principal that then is returned would be invested into one of those underlying securities. So happy to discuss this with you further, but that's our plan. So what this looks like on a monthly account statement is you can see the maturity date for each one of those underlying securities. You can see the price if it were to be sold now, especially with the market being down. And then as you see these unrealized gains or losses, that is reflective of being sold prematurely. And that's what shows for our performance right now. But like I mentioned before, our plan with these is to hold to those maturity dates, stay within our principal protection, and then be paid back at the original investment amount, provided that the underlying securities are within the principal protection buffer. Same thing with our market-linked principal protection notes. You can see the maturity date. This particular example I have on the screen shows $115,000 investment, but is now marked below that because the markets have been down. But the plan is to hold to those maturity dates and receive a full principal protection. So we'd like you to be aware as you read the statements that they can be shown or priced at a discount, especially if they're sold prematurely. As always, we invite your questions. We welcome communication with you. I hope that you find this content to be educational and helpful. Thank you.